So an author emailed me last week asking about a tax credit that she heard about from another author for producing audiobooks. Not a tax deduction where you can write off the cost of producing an audiobooks, but an actual tax credit where you could get money back, essentially making the audiobook free. She just wanted to know, was this a real thing? The short version is that the credit actually is real, but it doesn't work the way that her author friend thought it would. So if you were banking on that credit, or if you were hearing similar advice, I want to make sure that you don't get burned. So today I'm opening up my email inbox and I'm going to go through 4 real questions that I got from authors, starting with the audiobook tax credit. Now, if you're new here, I'm Seth Norris. I'm a CPA and I work with indie authors. And all of the questions that I'm going to go through today are actual real questions that I've received from authors. So if you have similar questions to these, you're definitely not alone. So question 1, the audiobook tax credit. Now, to understand this one and why it would be significant, you have to understand the difference between a tax deduction and a tax credit. A tax deduction reduces the amount of income that you're taxed on. So if you made $100,000 of income and you have a $10,000 deduction, you're getting taxed on $90,000. $90,000 times whatever your tax rate is going to be the taxes you owe. But a tax credit is dollar for dollar a reduction of taxes that you owe. It's applied after all of your taxes are calculated. So in that same example, if you had $90,000 of taxable income and after all the dust settles, you have $20,000 of taxes you owe, then a $20,000 tax credit would reduce your taxes by $20,000. You can see where like a tax credit is way more valuable than a tax deduction. Now, the specific tax credit that this author's friend was talking about is the disabled access credit. It's a great tax credit and it exists to help small businesses make their businesses more accessible to disabled people. Think of things like wheelchair ramps, accessible bathrooms, and those kinds of things. The purpose of the tax credit is to help businesses become compliant with things like the ADA or other regulations that help people with disabilities. And so since there's no compliance requirement to having your books available on audiobook, it doesn't qualify for this tax credit. Now, our youngest son is blind and he listens to audiobooks almost all day long. So I think it's a wonderful thing to get your books narrated or get them turned into audiobook. But unfortunately, this tax credit is not for that. This tax credit is specifically to get you in compliance with some sort of ADA or other type of compliance requirement. Now, the good news is that the money you spend on your audiobook for the narration, for the editing, for the production, and all of it is a fully deductible business expense. So you're not left high and dry. You still get some benefit out of it. But remember, with a tax deduction, your only benefit is your tax rate times that deduction. So if you're wanting to do audiobooks because you think it'll be good for your business, you think you could reach a wider audience, you think you can make more money off of them, or you think it'd be a great thing to do for the visually impaired community, then all those are great reasons to do an audiobook. But if your only reason for doing it is a tax deduction, then it might not be worth it. In general, we always say something should make business sense before it makes tax sense. Like it should be something you would have done without the tax benefit, but then let's get the tax benefit. Don't make a business decision just because of the tax benefit. Okay, question 2. Can you deduct the bookshelves that you install in your home office? I had a client who was paying thousands of dollars to get these gorgeous built-in bookshelves put into their home office. It was a legitimate home office used 100% for business, and he wanted to know, could he write those off as a business expense? And as with a lot of things with taxes, unfortunately, it depends. If those bookshelves are built in and they're structurally now part of the home, then instead of being a direct home office deduction, they just add to the value of the home. And in some cases, you can deduct part of the cost of your home or the value of your home as a home office deduction. You can only do that if you're using the actual expense method. There's another video, and I'll try a link to it, where we talk about the right way to deduct a home office. And if you use the way that we recommend, those bookshelves probably aren't going to help your tax deduction at all. But if you're buying like some IKEA bookshelves like I have in the back here, and you're just putting those in your office and they're not structurally part of the home, they're just part of your office space and you use them for business, then that would be considered furniture and fixtures, and you can deduct those on your taxes. Normally, things like that get spread out over several years, but because there's so many provisions like Section 179 or bonus depreciation, you can usually write off 100% of the cost of that thing in the year that you buy it. Again, it is a deduction, not a credit. So if you spend $1,000 on bookshelves and you're in the 25% bracket, you might save $250 on your taxes. Question number 3, and this is one that I actually get more often than you would think. Do you have to pay estimated taxes if you live overseas? For this specific author who asked me this question, the answer was no. And the reason for her that it was no is because her income qualifies for what's called the foreign earned income exclusion. If you're a US citizen and you pay US taxes, but for virtually the entire year you live overseas, then you may qualify for the foreign earned income exclusion. That provision lets you actually exclude from your income a large part of whatever you earned while you were overseas. For this particular author, 100% of her income fell under the threshold for that foreign earned income exclusion, so she wasn't paying taxes on any of her income. income. Now, the big caveat here is if her income were to spike or she'd have other income that were to spike, then it may cause her to go over that threshold where now she no longer qualifies for that foreign income exclusion, or maybe she's earning more than she can exclude and she has to start paying taxes. But in general, in her case, she was safe. And if you live overseas for the entire tax year, then you may not have to pay US taxes on that income. There's actually a lot of nuance in this, and there's different things you have to watch for. So make sure if you think you might qualify for this, that you talk to a tax professional first. I've seen some clients do things that actually negate that foreign earned income exclusion, like setting up an S Corp, because that S Corp income is now not considered earned income and did not qualify for the foreign income exclusion. So just be careful with this when it's not cut and dry. You really have to make sure that you're doing this one the right way. Question number 4, again with quarterly estimates, but this time it's a little bit different. Do you have to pay quarterly estimates if you have tax withholding from a W-2 job? So the way that it works is whenever you have income, whether it's from an S Corp or from an LLC or a partnership or a W-2 job or anything, all of your income from all of your sources is going to all get lumped together onto your personal tax return and all get included in total income. And some of that income is taxed a little bit differently. Some of it is taxed as capital gains. Some of it is taxed as dividends. Some of it is subject to self-employment tax or income tax. But all of those taxes are generally just added together to come up with your total taxes owed. And then from there, any tax credits you have or any tax payments you made, whether it was from withholding from a paycheck or paying quarterly estimates, get subtracted from the taxes you would have owed. And the bottom line is either your refund or the additional balance that you owe. So I've seen plenty of situations where you can have a business that's generating income that's adding to the taxes you owe, but then someone in the household also has a W-2 job where their withholding is not only enough to cover the taxes from their W-2 job, but also enough to cover the taxes from the business. Because again, it all just gets lumped together. All the income gets lumped together, all the taxes get lumped together, and all the payments get lumped together. So if you don't want to have to pay quarterly estimates and you'd rather just increase the withholding from a W-2 job that you have, you can absolutely do that. And sometimes it's actually better to do it that way. The IRS assumes that you made your income equally throughout the year, that if you made $120,000 for the year, that you made that at $10,000 per month. And so they want to see that your tax payments were also made equally throughout the year. Well, as an author, you know that your income doesn't come in equally throughout the year. So you can have a situation where even if you're paying in the right amount in quarterly taxes, if you don't match up those payments with the income when it came in, the IRS may still penalize you even if you paid in enough just because you didn't pay it in early enough. But with withholding from a paycheck, the IRS treats any withholding as having been made equally all year long. Even if you don't withhold anything from your paycheck for the entire year, and then on December 31st, you have a giant amount withheld from your paycheck for federal withholding, the IRS pretends like that amount was withheld equally the entire year. So if you're worried about the timing, if you have huge fluctuations in income and you're worried about making those quarterly estimates correctly, but you know about how much you should be paying in, you could just make those payments through W-2 withholding instead of having to worry about quarterly estimates and timing. So like if you're an S Corp and you're having to pay yourself a salary anyway, and you're having to pay payroll taxes anyway, you could just adjust your withholding on your own paycheck rather than having to start paying quarterly. All right, so this is just a sample of some of the questions that I get from authors, and they're all great questions. The tax code is extremely complicated and it's not easier for authors. If anything, it's actually harder. If you have specific questions that you want me to answer on this channel, you can actually put them in the comments, or I'll put a link in the description where you can send me a message anonymously and I'll get those answered in one of these videos. I hope that this was helpful. I hope that you see that there are no stupid questions, that there are no easy answers to a lot of these questions. Send me your questions and I will see you next time.